Hi guys, welcome back to my channel. Kelvin here. So just this week, the Fed raised interest rates by another 75 basis points, making the total interest rate to be finally as high as the previous peak in 2019. And with 3 more Fed meetings in 2022, we will be seeing the rates go up even more by the end of the year. But the interesting thing is, right after the Fed announced their rate hike, the markets all gave super big fat green candles. However, that's not the most exciting news this week. The more exciting news is that on July 28, 8:30 AM US time, the US will be releasing GDP advance estimate for the second quarter. And that's when we will finally find out whether we are in a recession or not. So what does this all mean for the stock market? Are we at the bottom yet? Or will there be a recession which will cause the market to crash even harder? So that is what I'm going to answer in this video. But before I start, I would greatly appreciate it if you can help to tap the like button and subscribe if you haven't done so. In return, I will show you a cute cat. Alright, let's start right now. Okay, just in case you don't know why the Fed is raising interest rates, here's a super quick explanation. Over the past few months, inflation has been going up super fast. And when inflation goes up too fast, things will become super expensive quickly. When that happens, everyone will cry father, cry mother, among many other things. So to prevent inflation from going up too fast and too furious, the Fed has to raise interest rates, which will make the cost of borrowing more expensive, which in turn make people spend less and eventually slow down inflation. So that's why the Fed has to raise interest rates. Now, we will think that rising interest rates are bad for companies because if you look at past data, as interest rates slowly goes down, the market slowly goes up. So according to logic, when the opposite happens, meaning when interest rates go up, the market should go down, right? Well, yes, but no. In the last rate hike cycle from 2017 to 2019, the market kept going up throughout the entire period. It's also the same for the current rate hike cycle. In March, May, and June, after the rate hikes were announced at 2 PM, the market immediately shot up on all occasions, including the current rate hike. Why like that? One theory suggests that rate hikes usually happen when the economy is strong. In the past 12 rate hike cycles, the market tends to give positive returns most of the time, averaging at around 9.4% positive return. And BlackRock agrees with this. They found that the 10-year yield has a positive correlation with companies' earnings. So in short, rising interest rates may not be a bad thing for the market, but rather it's the effect of rising interest rates that we need to be worried about. Because in the past, when interest rates rises too fast, growth and demand may slow down too fast, which will eventually cause a recession. And that has exactly been the case for the past few rate hikes. So you are saying that a recession will happen? Okay, before I answer that, let's first understand what is a recession. A recession is basically a prolonged decline in economic activity. And that is usually measured by a drop in GDP for 2 consecutive quarters. In the last quarter, we already had 1 negative GDP. And the result for the next quarter will be coming out on July 28, 8:30 AM US time. As of making this video, the result is not out yet, yeah? So I don't know if it will be positive or negative. But I can always guess, right? And my guess is, I feel that the GDP result is most likely going to be negative. Quick pause. Webull is a new stockbroker that lets you trade stocks for a low fee of $0. They also have fractional shares, which lets you buy stock with even just $5 hongbao money. Right now, Webull has upgraded their latest sign-up promotion. If you sign up, deposit at least $2,000, then make 6 buy trades on either US stocks, ETFs, or options, you will receive up to $120 worth of Microsoft shares. This promotion ends on August 1st. So if you are interested, you can sign up with my link down below. With that being said, let's get back to the video. So, recession confirmed? Siao ah! Hold up, not so fast. Just this week, the US president has come out to say that the US is not going to be in a recession. Papa Powell also said the same thing. This Kelvin said got recession, but the US president and the Fed says no recession? Then who to believe? Okay, let me explain. Just last week, the White House released an article explaining how the pros determine whether we are in a recession or not. Why are they releasing this now? Is it because they already know the result? Sus. Anyway, in the article, they mentioned that even though some people use a decline in GDP for 2 consecutive quarters, that is neither the official definition nor the way economists evaluate the state of the business cycle. Instead, economists look at a lot more specific data like income, spendings, industrial production to determine whether we are in a recession or not. And as you can see, stuff like personal consumption expenditure, industrial production, payrolls and real income are all going up. Or in other words, the economy is still doing well. That's why economists believe that even if the upcoming GDP data turns out to be negative, it is just going to be what we call a technical recession. So just a recession in name, but without all the scary side effects that come with a real recession. Now, the question is, will there eventually be a real recession or not? You know, where people lose their jobs and the market crash? The answer is, I don't know. According to the White House articles, the chance of a recession happening is never zero. And according to a Bloomberg report, there's a 38% chance that a real recession will happen in the next 12 months. Which is like, God say, but no say. If only there's a good way to tell if a real recession will happen or not. Oh, turns out there is a way to tell. In the White House article, they mentioned something called the sum rule. What's that? Can eat one nah? Oh, and don't bother reading the explanation because it's super confusing. So let me explain in a simple way so that even a 5-year-old can understand. Basically, they found that whenever unemployment rate goes up for too long, a recession will happen. To understand it better, look at this video by Duomo. When the sum indicator goes up by 0.5%, a recession will happen. And right now, the sum indicator is at 0. So we are nowhere near a real recession yet. This is because the job market is still doing very well. All this is mainly due to the fact that a great resignation just happened not too long ago, where over 4.5 million workers quit their job in just March alone. Check this out. Job openings are at all-time highs. Many people are still quitting their jobs. And even though we have seen a lot of tech layoffs, on the whole, layoffs are still very low. All this just shows that it's super hard to hire new employees now. So unless times are bad, companies want to avoid laying off talents unless they have no choice. So for now, we don't really know if a real recession will be coming or not. Yes, yield curve inversion can indicate that a recession may be coming. Yes, surges in oil prices can lead to recession. And yes, when inflation is too high, it can also lead to recession. All these have happened. But I still feel that it's still too early to tell because not even professional economists can tell whether a recession is coming or not. Right now, there are still some economists who believe that a recession will not happen. So for now, we will just have to wait and see, yeah? With that being said, there are still some things that you can do to prepare yourself for a possible recession. First, if you have any high interest debt, chop, pay off because high interest debts will only make you poorer. Pay off as soon as you can so that you have enough money to invest and what big. Second, keep at least 6 months worth of emergency funds. If a recession does indeed happen, there will be layoffs everywhere. Pro tip, rather than keeping all the emergency funds in a bank, what you can do is keep some in a high interest account. Then maybe put 20 to 30% into something safe, but can still give you a high interest. For example, the Singapore savings bond. That way, your money won't just sit around and do nothing like a lazy bum. Next, if you have a home loan, try to fix your rate as soon as you can. Right now, mortgage rates are already at 3% and it's expected to go up even more. So if you can refinance now, quickly go chop, do it. Finally, invest consistently. Dollar cost average doesn't only work when the market is going up. It is also for when the market is going down, like right now. Yes, a recession can happen. And yes, the market can crash another 20 to 30% or even 100%. You never know. But as long as you are dollar cost averaging in consistently, you will do well over the long term. Because stonks. Anyway, that's all for this video. Hopefully, you find it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.